This is why covered calls are a devil's bargain.
Covered calls to generate income is financial bullshit. These strategies are mechanically
All right, coming out swinging. I like it.
expected to underperform their underlying equity and increasingly so at higher targeted levels of distributions. For long-term investors, covered calls increase risk by leaving the downside unprotected while capping the upside, eliminating the mean reverting behavior of stocks, an important feature of stock returns. I'm Ben Felix, Chief Investment Officer at PWL Capital, and I'm going to tell you why the so-called passive income from covered calls is a devil's bargain. The preference for income is one of the strongest behavioral biases in investing. It can make people do silly things. In their search for income, some investors look for funds that pay high distributions. This is well known by fund managers who use high distribution yields to attract investor dollars. The problem for investors is that marketing these yields, in the case of covered calls, as income, or even worse, as expected returns, is financial bullshit. Bullshit is not a lie, to be clear. It is indifference for the truth. Selling a high distribution yield as an expected return ignores the fact that yields on covered call strategies are inversely related to their expected returns. Higher yields mechanically mean lower expected total returns. Total returns, to be clear, are what you need to buy groceries. I'm going to walk through why distribution yields are not returns, how covered calls reduce expected returns, and why I think the return profile of covered calls makes them particularly risky for long-term investors.
Let's talk about what a covered call is. First off, you need to own the stock outright. If you don't own the stock outright, this is essentially a short put, a put that you've sold. So if you own the stock outright, open image, a new tab. There we go. That's way big. That's what I'm talking about. Okay. When you own the stock outright, of course, you only make money if the stock goes up. We know this. And you lose money if the stock goes down. We know this. If you sell a call, so for every 100 shares of the stock, you sell an out of the money call against those shares, you generate, quote, income. You take in the premium of the call that you sold. Now, let's use an example here. Let's say that you are, let's go to AMD. Let's go to AMD just for funsies, no other reason. So let's say that I wanted to own AMD stock at 160 and I wanted to sell the 175 calls against it. So if I purchased 100 shares at 160 and then I sold a call, the 175 call, and I sold it for $3.30, that means for every one share, my cost basis has been reduced by that amount, which sounds great, right? Sounds great. So 160.46 minus 330 means that my cost basis in this is at 157.16. So that sounds brilliant. That sounds brilliant. Now, if I'm a long-term investor, I could do this every month, right? And so that's where a lot of people get excited because they're like, listen, I'm going to hold on to AMD. I'm an AMD bro. I'm going to hold on to it until I die. So if I take $3, $3 a month, so 160 divided by $3, that means in 53 months of selling options, I have a free stock. That's so sick. I'm so happy about this, right? Now, of course, you still have unlimited downside risk because the stock can still go down. Your calls do not add any risk to the trade whatsoever, which is actually one of the huge benefits of selling a covered call. By selling a covered call, there is zero additional risk added to the trade, period. What does happen is you take in that credit and it moves back your break even, like we just talked about, right, to the 157, but you cap your gains. Your gains are absolutely capped. They are capped at where you sold this call at. So the price can go from 160 to 175 and you get to keep all of that. But once it goes to 175.01 and it expires at 175.01 or greater, you no longer own the shares. So you don't get to participate in any big upside moves. Now, the real hack here, I used to call this the triple stock profit system, is if you find a stock that pays a dividend and that stock you can sell covered calls on, and the stock is going up in value, you're making money three different ways. So covered calls, in a nutshell, if you plan to hold the stock forever, make a total amount of sense. as long as it doesn't go above your strike that you sold. And even if it does go above the strike that you sold, you still get to keep all those gains. All right. It's not like you lose money on the stock. The only way you lose in this trade is if it goes down, just like if you would be holding the stock elsewise. So now with that out of the way, let's keep going.
To avoid being too theoretical, I'm also going to go through the performance of a bunch of covered call funds to show that what I'm saying is not just theoretical, it is exactly what's happening in the live funds. Let's start with some background. Selling a call option on an equity that you own generates income and creates a liability that empirically more than offsets the income received. This makes the distribution yield on covered call funds a misleading metric. Selling a call option means selling the right to buy the underlying stock at a predetermined price, called the strike price, in exchange for a premium. An equity covered call strategy invests in stocks and sells call options on those stocks. A fund using this strategy typically distributes the derivative income from selling calls as
Okay. So remember, what they're saying is the $3 that you sold this call for, right? The $3.30 that you sold this call for, because the fund owns the shares, they are still buying or selling the covered calls, I should say, and then they're distributing it out like this.
cash to investors, resulting in their high distribution yields. While those distributions may feel like investment returns, selling the call is only the first step in the trade. The fund has sold the right to buy the underlying stock at the strike price. If the price of the underlying rises above the strike price, the option holder, who the fund sold the option to, will exercise their call option and the fund will have to sell the stock at a price below its market value, putting a cap on upside returns.
There you go. The cap on the upside returns, right? And so let's say that your stock is just high flying. It's amazing, right? You don't get any of that. You're toast, right? You are absolutely capped to the upside, but you are not capped to the downside. You are not capped to the downside. Anthony has a fantastic question or a fantastic point here, right? And it's interesting that most brokers will approve inexperienced traders for level one options, which include cash secured puts and covered calls. Hey, Anthony, do me a favor. Tell me the difference. Everybody in the chat, tell me the difference in what does a covered call look like versus what a cash secured put looks like. I should play a little. I should have like a little Jeopardy music going in the background. What is the difference between what a covered call looks like versus a cash secured put? Covered calls versus cash secured puts. If you said they look identical, you would be correct. No, it's not even flipped. It's the same profile. They are absolutely the same. Absolutely the same. Yes, exactly. Because a covered call has unlimited risk to the downside because of the stock you own. A short put, a cash secured put, has unlimited risk to the downside. It is capped to the upside because of the call that you sold. This is capped to the upside because of the nature of selling a put. They're the same. They are the same thing. Now, really, the only difference here is that in the covered call, you've already put up margin for the shares, or maybe you've paid for the shares in full, whatever your brokers got you set up as. And then there may be a different amount of margin for the cash secured puts. That's it. They are the same thing. I'll take identical for 100. Yes, exactly. They are the same thing. Now, what happens? Does anybody remember the golden rule of leverage? The golden rule of leverage, whether if you're in covered calls or if you're in cash secured puts, what is the golden rule of leverage? It is never put yourself in a situation where you can lose more than you can make. Cash secure put, covered call are the exact same thing. Jay Fort's brain just exploded. Yeah. They are one and the same thing, and they both break the golden rule of leverage. Let's continue.
Okay, I want to dig a little deeper into the mechanics of what's going on from the perspective of expected returns. Call options are positively exposed to their underlying equity, measured by a term called delta. Buying a call option on a stock gives you positive exposure to the price.
By the way, I have to ask, you've probably watched several of these options deep dive videos by now. Put a number 1 in the chat if you feel like you have learned so much by watching a random guy on the internet teach for free what people try and charge you tens and tens of thousands of dollars to learn. Or put a 2 in the chat to tell me, you know what, this just isn't the thing. I don't get it. It's no it's not a big deal. I don't need this, right? I really hope that we're just flooded with ones, because we go into all kinds of super deep dives like this on a weekly basis, which is making you a better investor, which is making you a better trader, which is hopefully making you a lot more money and putting you in a situation where you don't make the mistakes that tons and tons of people do. There you go. All kinds of ones. Really appreciate that.
Movements of that stock. Selling a call on an asset that you own, a covered call, reduces your exposure to the underlying stock. You're shorting exposure to the underlying equity by selling the call option. Holding option maturity constant, call option prices and deltas monotonically increase in a decreasing strike price. If you want higher income on your covered call strategy, you can sell options with lower strike prices, resulting in higher income and, importantly, higher short delta. This is crucial in understanding how yields are related to expected returns. In simple terms, higher yield mechanically means lower exposure to the underlying asset by being short a higher delta option, and correspondingly, it means lower expected returns. When you sell
Hold on. That was deep. Let me go back.
your delta option, mechanically, how yields are related to expected returns. In simple terms, higher yield mechanically means lower exposure to the underlying asset by being short
I may have to run this at a slower speed. Hold on. My itty bitty baby brain is not keeping up with his mouth.
a higher delta means lower returns. In simple terms, higher
I love how he says in simple terms, and I've had to watch this 3 times now to catch what he's saying.
yield mechanically means lower exposure to the underlying asset
Higher yield means lower exposure to the underlying asset.
by being short a higher delta option.
By being short a higher delta option. Higher delta option. So is he saying higher delta meaning like 80? Because you're not taking in much extrinsic value in that case, which is all that you want when you're selling covered calls, is you want that extrinsic value.
And correspondingly, it means lower expected returns. When you sell the call option, you receive an option premium that feels like income and is packaged up and distributed by covered call funds as a cash distribution. But the fund now has this liability, the potential need to sell the underlying shares below their market value if the price rises above the strike price.
Okay, you lost me there. That was not simple terms. I'm a little, I'll 100% transparent here. I'm a little confused by what he's saying. What I'm assuming he's saying is rather than sell like a 16 delta option and collect $1.69, selling a 44 delta option to collect 630. Okay. I got it. What he's saying here, yes, I totally get it now. Okay. My itty bitty baby brain kicked in. Okay. So rather than selling out of the money, let's say at the 60 delta for $1.70, he's selling so closer to the money for 635. So you take in a significantly higher amount of premium, right? How much is that? Like 5 times higher? 635 divided by 1.7, three times higher. Oh, can't be right. 1.7 divided by 6.35. What am I doing wrong? 6.35 divided by 1.7. Oh, okay. It's almost 4 times higher. There you go. Okay. So 3.73 times higher, but by doing so, by taking 635 in credit versus $1.71 in credit, you're only allowing the stock to go up $5 before it's called away. There we go. Okay. Yeah, it definitely flew over my head, but I got it. So we aren't letting the stock run, but we are collecting more extrinsic value. So that's what he's saying here. And that's the real hang up, is that they, in this particular strategy that they're doing for these covered call ETFs, is that they're selling close to the money. So the stock has no room to run, just so they can collect more of that premium to send back to the investors. So the only thing that can happen is for the price to go down. You catch what I'm saying here? Because we aren't giving it any room to go up. In fact, they may even be doing at the money. So they're selling at the money calls, which will immediately be called away. So they can collect that $8 in premium to send back to the investors. And if the price goes down, the price is going to go down on the asset value. Got it. Okay. That was not in simple terms, but I eventually got it. Put a number 1 in the chat if you got it. Put number 2 in the chat if it still needs a little work. But I get it now.
This liability exists until the position is sold or the option expires. Remember, the expected return of the short call is increasingly negative with an increasing derivative yield. Here's why this matters. Over the full life cycle of this type of trade, the outcome is generally worse than simply having held the underlying equity. Part of the reason
And you can see why it's worse because you don't give it any room to run, right? You're saying, okay, give me the premium now, I'll take it, and then immediately call the shares away. We're going to distribute those premiums to the investors. And then if the price goes down, oh man, that sucks. I'm sorry, guys, my bad. Okay. Don't check out Random Guy. This is deep.
reason is a lower equity beta, meaning less exposure to the equity risk premium. To be clear, this is something that you could do by simply reducing your exposure to the stock directly and holding some cash. I'll come back to that with an example later. The problem is that the reduction in exposure to the equity risk premium is also asymmetric.
Boom, J Fort nailed it. You're limiting your upside and letting your losses run out of control. That's exactly what they're doing here with the sexy factor built into, oh, I'm taking in $8 in premium. Isn't that great? Isn't it beautiful that I can collect that $8 in premium and distribute it as a dividend to all of my investors? But I'm never going to let the stock go up. And the only thing that can happen is for it to go down. Okay, I totally get it now. Good one, J Fort.
Metric. You keep most of the downside while capping your upside at the strike price. This means that
Okay, we're going to rewind 10 seconds here because he just explained exactly that.
an example later. The problem is that the reduction in exposure to the equity risk premium is also asymmetric. You keep most of the downside while capping your upside at the strike price. This means that through any periods of market volatility, which are of course common in equities and stocks, you eat most of the downside, but you do not participate in a large portion of the upside.
Boom. Aussie EM. Price goes up, it gets called away. Price goes down, you lose. You lose both ways.
Systematically missing out on stock market recoveries, which are common.
Dave, because it doesn't hit the hang on. Let's caveat this. It can hit the strike price, but if it is 1 penny in the money at expiration, like I was saying earlier, if it's 1 penny past 170, we'll use 165 here. If it's 165.01, it will automatically be executed by your broker and called away. You cannot do anything about this at expiration. Now, can it go up to that point and back down? Sure. But if it is 165.01 or anything greater than that at expiration, it will be taken out of your account for sure. 100% not going to be able to avoid that.
After major downturns can be very expensive. Before I continue, I do need to mention a potential saving grace for covered calls, the volatility risk premium. Equity options tend to be priced with an implied volatility higher than realized volatility. This creates the opportunity for option sellers to earn an expected risk premium for enduring the risk of an extreme event where realized volatility exceeds implied volatility. While it makes back-tested cover call strategies look really good, in recent history, since about 2011, the volatility risk premium has not been anywhere near sufficient to offset the reduction in equity exposure from selling the options.
You know, there's a couple people in the chat talking about rolling for sure. This is a perfect example as to why. If I get a week to expiration, I'm rolling it out in the future. If I can't roll it out in the future because of liquidity reasons, I'm going to close it now. I'm not taking this risk. There you go. Great point, Jamie.
Resulting in poor performance for these strategies. This kind of thing can happen when a trade becomes too crowded by, say, the proliferation of retail funds chasing the strategy. I want to make sure it's really clear that the point about asymmetry is particularly important for long-term equity investors who have historically benefited from a little bit of mean reversion in stocks, making stocks a little bit less risky at long horizons than they would be if returns were completely random. In simple terms, after stocks have performed really poorly, they tend to perform a bit better than average. This is in contrast to bonds, which do not tend to have the same rebound effect after poor performance. In fact,
Well, I mean, don't get ahead of yourself there. Downtrends can go on for months and months and months and years before they find a bottom. Right? That stage 4 can be brutal before it ever hits a stage 1 or stage 2 to come back up.
bonds often continue having poor performance after having poor performance. Based on this, some research has suggested that the higher expected returns and mean reverting tendencies of stocks make them less risky than bonds for long term investors, including long term investors who need to live off of their investments. But here's the problem: selling calls on your equity positions both lowers the expected returns and eliminates the mean reverting tendency of stocks by capping the upside return, while only slightly improving the downside by the amount of the option premium. Again, getting most of the downside with a limit on upside is not good. I would argue that it makes covered calls very risky for long term investors who are concerned with funding their inflation adjusted spending. This might be hard to believe given the large distribution yields of these strategies, but it's important to remember that these distributions are not income in the way that, say, bond interest is. And presenting them this way is irresponsible. The option premiums come with an associated liability that lowers expected returns and transforms the shape of the distribution of returns into something much less favorable for long term investors. One of the biggest problems I see for these funds is that their distribution yields are often much higher than their total expected returns. Yet they're occasionally discussed in income investing and FIRE communities as if their distributions are perpetually sustainable. It even gives some people the idea that they should borrow money at, say, 5% to invest in covered call funds with a 14% distribution yield. The combination
So Wes has a good question. What do you think about selling calls against a long position that's already so in profit? You've already rolled up and you hold the calls risk free. I hear where you're coming from, but what you do in that case is you've created what's called a call debit spread. By selling the calls that you already are profitable on, okay? Now you can have a long and a short call at the same time, just not on the same strike, okay? So he's already super profitable on this one, is what he's saying, the one that he's already bought. But he's talking about now selling calls against those. Wes, if you do that, you cap your gains. Like it, in my opinion, and granted, I'm just a random guy on the internet, don't listen to anything that I say. In my opinion, you're locking yourself out of potential profits. If for some reason you don't think that the long call will continue to perform, then in my opinion, you should close the long calls, not set an artificial cap against it, and therefore keep the trade on, but now limit how much you could possibly make. There you go. That's my opinion.
of high distribution yields, lower expected returns, an uncapped downside, and a capped upside means that
Oh, I see. Has a great point. A great point. Let's go to AMD since we're talking about AMD today. This is a really, really brilliant point. So everybody in the chat, type IC to commend IC for actually putting up a really, really solid point here. Imagine selling covered calls all the way down on the stock you own, and then as soon as it turns around, it gets called away from you. That's such a brilliant point, and exactly what could have happened to a ton of people in AMD thinking that they were so smart. Like, oh man, I don't know anything about this outlier trend template with a 10 over 20 price over 50. Alls I know is prices are going down. I'm going to load the boat on more stock and I'm going to sell calls against it. It's a brilliant strategy. And then it gets to right here and all their stock is gone. They've got no upside potential left, but they lost all the way down. It's a great point, dude. Absolutely great point.
someone who's spending the distributions could deplete their capital fairly quickly. This is another reason why calling these distributions passive income is financial bullshit. If you need a psychological trick to help you spend down your capital, covered calls might be the answer, but their distribution yields are not a sustainable source of long term income. I'll say it one more time: covered calls are not good for long term investors. Stocks have positive expected returns and mean reverting tendencies. Covered calls reduce exposure to the underlying stocks and chop off the right tail of the distribution of returns, capping the ability of the underlying to recover from downturns. This effect compounds over time, driving an increasingly large wedge between the performance of the covered call strategies and their underlying equities. This is true in any market conditions. I often hear that covered calls are great in a sideways market, but equity markets don't go sideways. They are volatile even over periods where they have flat returns. Every time your covered call strategy eats downside and is denied upside, you are losing. Okay, That's all fine in theory. Let's look at some live funds. There are quite a few covered call ETFs with reasonably long histories to examine. These can be compared to ETFs investing in the underlying equities without selling calls to see all of the points I've made so far happening in live products. I looked for covered call ETFs with minimum 10-year histories. BMO has a few that launched in 2011. The BMO Covered Call Utilities ETF launched October 20th, 2011. It currently has a distribution yield of 7.37% compared to 3.43% for an ETF of the underlying equities. In periods where the underlying equities do not perform well, the covered call fund has been able to outperform, but these periods have tended to be brief and in the long run are far more than outweighed by the capped upside. Over the full history since inception, the covered call fund has trailed the underlying by an annualized 2.6 percentage points, and it has trailed the underlying in more than 70% of 3-year rolling periods with a 1-month step. Increasing the rolling window to 4 years results in the covered call fund trailing nearly 85% of the time. The underperformance is particularly pronounced when the underlying equities drop dramatically and then recover, which is a pretty typical characteristic of equity returns.
Which is exactly what IC is saying. He's I appreciate what he's saying here, but he's talking really, really, really high level. So I understand if you're struggling to keep up. I'll do my very best to try and translate what he's saying here.
As I mentioned earlier. I also mentioned earlier that reducing equity beta by holding cash can get you to a similar place as a covered call, at least from the perspective of beta. I ran a portfolio of 60% BMO equal weight utilities and 40% cash, well, high interest savings account, from October 2013 through August.
Wait, he runs funds and then he also sits in cash and doesn't F up his portfolio? Weird. It's almost like he, as a professional fund manager, knows to wait in cash and not F up, like I tell you all the time, to treat your account like you are a professional fund manager. Isn't that great?
August 25th, 2025. You can see they track pretty closely most of the time, except that the covered call fund gives up extreme upside events and eats the whole meal on the downside. I won't
Gives up the upside. We already talked about that. It has the entire downside risk associated with it. So that's pretty cool. Look at that. I'm really proud of you because as you watch these options deep dives, as you watch an actual legitimate fund manager, just like yourself, trade, a lot of times sitting in cash and not effing up is a big part of the plan. And you are learning to do that as well. And I know it's not fun, and I know it's not sexy, and I know it's not exciting. But who cares about that when at the end of the year, you have way more money in your account than you would have otherwise because you just were in it for the action?
keep repeating that equity plus cash comparison, but Jeff Patak, managing director for Morningstar Research Services, recently showed in a sample of 22 single stock covered call ETFs that a combination of cash and the underlying stock outperformed most of the funds, had lower volatility than all of the funds, and had a higher Sharpe ratio than most of the funds. Another
How's that sound? Right. Have more returns and less volatility in your account because you understand the power of holding cash. Sounds good to me.
BMO fund with a reasonably long history is the BMO Covered Call Canadian
Thank you, Steve. You're very, very welcome.
Banks Fund. It launched January 28th, 2011. It has a current distribution yield of 6.13% compared to 3.61% for an ETF of the underlying equities. It has underperformed by an annualized 2.71 percentage points since inception, and it has only outperformed in less than 1% of rolling 3-year periods since inception. The Global X S&P TSX 60 covered call ETF launched on March 16th, 2011. It currently has a distribution yield of 7.67%. It has trailed the iShares S&P TSX 60 ETF by 3.65%.
Okay, we may have to rage quit this video because he's talking too high level at this point. But what I'm trying to get across here is, and it is represented here, is that covered calls give up your upside potential. And the green line right there shows how much upside potential that you're giving up. In fact, let's draw on this. Let's draw on this. So you get all that downside, but the upside, the spread between what the stock would do on its own and the stock having the covered call widens and widens and widens because you get all the downsides and then your upsides are capped. And then if you want to continue to stay in this stock as it's moving up, you have to buy it for a higher and higher price and then sell more calls against it. And that's going to suppress your returns again and again and again. And the common theme here is underperformance. Exactly. Because you limit your upside, but you keep all the downside. So, Options Deep Dive Wednesday, that was a great video. Now, I'm not saying you shouldn't ever sell covered calls. By all means, if you have found that works for you, you're comfortable with the risk that you're putting on, right? I would only do this if you plan to hold the stock forever. I would definitely consider doing this on stocks that already pay a dividend. So you're getting the call income and the dividend income. And I would also give it room to run, right? The rule of thumb that I always heard, which, oh, I stopped screen sharing 2 seconds here. The rule of thumb that I always heard is go for like a 20 to 30 delta. 20 to 30 delta means that 20 to 30% of the time it'll be in the money. Let's say right here, like the 180. So 20% of the time it'll be at the money at expiration, but the other 80% of the time you get to participate in that growth. And you don't take on any additional risk whatsoever. Like there is zero additional risk if you own the stock outright and you do a call. There is no additional risk. But the downside, the trade-off, is that you're collecting the premium, but you get to cap your upside. So there we go. Did you learn something today? If you learned something today, type the number 1 in the chat. And of course, if you're ready to save time, make money, and start winning with less risk, click one of these 2 videos and have a fantastic day. We'll talk soon.